Nothing here is financial advice. Always do your own research and never invest more than you can afford to lose. Imagine waking up one morning to find that the world of money has quietly shifted beneath your feet. Banks still exist, credit cards still swipe, and cash still crumples in your pocket. But behind the scenes, a silent revolution is unfolding. It's called Web3, and it promises something radically different. An internet where you own your identity, your money, and your digital assets, without middlemen, without permission, and without borders. To understand Web3, we need to rewind. Web 1, the 1990s, was the read-only internet. Static pages, directories, and hyperlinks. You went online to consume. Web 2, the 2000s to 2020s, became read-write. Social networks and platforms where anyone could publish, comment, and share. But it came with a price. We built our digital lives on other people's servers. A handful of platforms captured our attention, our data, and our value. Web3 is the proposed next stage, read, write, own. It says your identity should live in a wallet you control. Your value should move like email. Your assets, whether a dollar, a song, or a deed, should be portable across apps you choose. It's a big promise, and it collides directly with how money and power have worked for centuries. So where do gold and silver come in? For thousands of years, people trusted precious metals as stores of value. They're scarce, durable, and universally recognized. But they're slow to move and hard to divide. Crypto assets flip the script. They're natively digital, programmable, and borderless. Now, with tokenization, we can fuse the old and the new, representing physical gold or silver as tokens on a blockchain, tradable 24/7 in tiny fractions. This documentary-style guide is your complete practical tour. We'll break down how Web3 works, show you the starter kit, walk through investing in tokenized gold and silver, explore crypto strategies inside Web3, and then go deep on the risks and criticisms. Because Web3 is powerful, but it's not a fairy tale. Finally, we'll look at where all of this might be heading over the next decade. Before we begin, none of this is financial advice. Markets are volatile. Always research thoroughly, use reputable platforms, protect your keys, and consider professional counsel. Ready? Let's dive into the engine room of Web3. Understanding Web3. At the core of Web3 is the blockchain, a coordinated network of computers maintaining a shared ledger. Imagine a spreadsheet duplicated across thousands of machines. When one row updates, they all update. If someone tampers with one copy, the others disagree, and the dishonest version gets rejected. Consensus beats corruption. Bitcoin's chain proved you could have scarce digital money without a central administrator. Ethereum added a programmable layer, smart contracts, that turned blockchains into general-purpose platforms. From there sprang decentralized finance, DeFi, non-fungible tokens, NFTs, decentralized autonomous organizations, DAOs, and tokenized real-world assets. Smart contracts are code that enforce rules automatically. Think vending machine economics, insert inputs, get outputs, no cashier, no permission. They power lending protocols, exchanges, prediction markets, and more. They also introduce new risks. If the code has a bug, the bug becomes the law until it's patched or governed around. Tokens are the lifeblood of Web3 economies. We can group them broadly. 1. Cryptocurrencies, BTC, ETH, SOL, as money or network fuel. 2. Stablecoins, USDC, USDT, DAI, pegged to fiat for low volatility. 3. Governance or utility tokens that grant voting rights or utility inside a protocol. And 4. Asset-backed tokens that represent off-chain value like gold, treasuries, or real estate. DeFi replaces bank functions with code. Instead of filling forms to borrow, you lock collateral into a smart contract and mint a loan. Want to earn a yield? Supply liquidity to a decentralized exchange, DEX, or lend stablecoins to a money market protocol. No branches, no bankers, just wallets and contracts. The benefits: transparent ledgers, fast settlement, and global access. The trade-offs: self-custody responsibility, smart contract risk, and the need to understand how fees and liquidations work. NFTs are certificates of uniqueness. They can be art, tickets, in-game assets, domain names, or even receipts representing a share of something in the real world. The hype cycle around profile picture collections overshadowed the steady march toward utility. Event passes, loyalty memberships, and proof of attendance credentials are practical today. DAOs bring governance on-chain. Token holders can propose, debate, and vote on changes. The promise is programmable, transparent organizations with treasuries you can inspect on a block explorer. The reality is messy: low voter turnout, plutocratic dynamics, and coordination problems. Still, DAOs continue experimenting with grants, investments, and community-run products. Perhaps the most transformative idea for traditional investors is tokenization. A bar of gold in a vault can be represented as digital tokens, each equal to a precise fraction of that bar. Now gold can be traded like a stablecoin, fractionally, instantly, globally. Similar logic applies to silver, treasury bills, carbon credits, and property income streams. Why care? Because Web3 shifts the locus of control. In Web2, your accounts can be frozen, your reach throttled, your terms changed. In Web3, you control private keys. Assets live in addresses you hold, and you can permissionlessly connect to markets. That power comes with responsibilities. If you lose your keys, there's no password reset. Security becomes a personal discipline. Let's preview the security mindset. Never share your seed phrase. Treat signing a transaction like signing a contract, because it is. Beware of fake links, fake tokens, and social engineering DMs. Use multiple wallets for separation of duties, a hot wallet for day-to-day exploration, and a hardware wallet for savings. Finally, remember that decentralization is a spectrum. Some projects are credibly neutral and open, others are decentralized in name only. Look at validator sets, token distributions, admin keys, upgrade paths, and governance forums. Web3 invites you to become a better detective. Getting started in Web3. Let's build your starter kit. We'll set up a wallet, acquire crypto, learn to use decentralized apps, and adopt a security routine that protects you from common traps. Step 1. Choose your wallet. Software wallets like MetaMask, Ethereum and EVM chains, Phantom, Solana, or Rabbi live in your browser or phone. Hardware wallets like Ledger or Trezor store keys offline. A practical combo. Use a software wallet for small, everyday interactions and a hardware wallet to secure long-term holdings. When you create a wallet, you'll receive a seed phrase, 1224 words. Write it on paper or metal. Store it in 2 safe places. Do not take screenshots or cloud sync it. Anyone with that phrase can move your funds. Consider a passphrase, an extra word for added security. Step 2. Fund your wallet. The easiest on-ramp is a reputable centralized exchange, CX. Buy a starter amount of your base asset, ETH for Ethereum, SOL for Solana, etc., and withdraw to your self-custody wallet. Always test with a tiny transaction first. Confirm the network, don't send ETH to a BTC address, and verify addresses carefully. Step 3. Connect to a dApp. Visit a known URL, bookmarked, click Connect Wallet, and review any prompts carefully. To make a swap on a DEX like Uniswap, you'll select the token you have and the token you want, check the fee, gas, and confirm the trade in your wallet. If something looks off, cancel it. There's always another trade. Stablecoins are your Web3 cash. USDC and similar tokens let you park value without exposing yourself to price swings. They also power most DeFi strategies, lending for yield, providing liquidity, or setting up automated strategies in vaults. Security routine, non-negotiable. Double-check URLs, use bookmarks. Read transaction pop-ups. Know what you're granting. Revoke token approvals periodically. Keep your device malware-free and your browser extensions minimal. Segment risk, hot wallet, explore, cold wallet, store. Common traps to avoid. Airdrop phishing, fake customer support in DMs, too good to be true yields, free mint scams, and copycat token tickers. If a site asks for your seed phrase, it's a scam. If an influencer guarantees profits, walk away. Investing in gold and silver on Web3. Let's talk precious metals inside Web3. The classic advantages of gold and silver, scarcity, durability, recognition, meet tokenization, which offers divisibility and instant transfer. How tokenized metals work. A custodian stores metal in a recognized vault. A regulated issuer mints tokens, each representing a specific quantity of metal, for example, 1 fine troy ounce per token for gold. You can buy, sell, or transfer those tokens 24/7. Some issuers let you redeem tokens for physical bars, subject to fees and minimums. Benefits. Fractional access, stack $20 at a time instead of saving for a full ounce. Global liquidity, trade day or night. Fast settlement, seconds to minutes instead of days. Programmability. Use tokenized gold as collateral in DeFi or for automated savings plans. Key risks. Custodian risk. Do you trust the vaulting and audits? Issuer risk. What happens if the company fails or is sanctioned? Regulatory risk. Tokenized commodities may face changing rules. Market risk. Spreads, liquidity, and peg dynamics during stress. Due diligence checklist. 1. Read the white paper and terms. 2. Verify the vault location and auditor. 3. Check redemption policies and fees. 4. Review on-chain contract addresses from the official site only. 5. Look for independent attestations and community track records. Example use cases: hedging crypto volatility with a slice of tokenized gold, dollar cost averaging DCA, small amounts weekly, sending a fraction of gold to family abroad as a gift, or parking funds in tokenized silver when sitting out a risky trade. Portfolio framing: precious metals can act as a volatility dampener inside a crypto-heavy Web3 portfolio. A simple approach: 5-20% in tokenized metals depending on your risk tolerance and time horizon. The exact mix is personal. The point is balance. Exit strategy: understand how you'll unwind. Can you swap back to stablecoins on a DEX with decent depth? Are there centralized exchanges that list the token for off-ramp? If physical redemption matters to you, confirm minimum redemption sizes and logistics before you buy. Investing in crypto on Web3. Now the broader crypto playbook: how to participate in Web3's native assets thoughtfully. Tiered asset map. Tier 1. Blue chips, Bitcoin and Ethereum, core positions, long time horizons. Tier 2. Platforms and middleware, leading L1S/L2S, staking assets, oracles. Tier 3. DeFi and infrastructure tokens, DEX, money markets, liquid staking. Tier 4. Opportunistic, early stage, thematic or high beta plays, small allocation only. Position sizing. The further you move from Tier 1, the smaller your allocations should generally be. Consider a core satellite structure: 60-80% core, BTC/ETH/stables, 10-30% satellites, 0-10% speculative. Staking basics. Proof of stake networks pay rewards for helping secure the chain. You can delegate to validators or use liquid staking tokens to keep flexibility. Risks include slashing, smart contract bugs, and depegs for liquid staking derivatives. Rewards vary with network economics. DeFi yield in plain English: you get paid for taking risk other people don't want, rate risk, liquidity risk, or market-making risk. Examples: lend stablecoins to earn a variable rate. Provide liquidity to a trading pair to collect fees and bear impermanent loss. Or deposit assets in a vault that automates strategies. Impermanent loss happens when the price of the two assets in your liquidity pool diverge. Your dollar value can end up lower than simply holding. Fees can offset this, but not always. It's a professional's game. Start small and measure. Trade execution and hygiene. Use limit orders where available, mine slippage, and avoid thin liquidity. Expect volatility. Build positions with DCA or ranges rather than all-in purchases. Keep a journal: entry price, thesis, invalidation, and exit plan. Taxes and records. Web3 generates many transactions. Use portfolio trackers and export CSVs early. Don't leave this for year-end. Risks and criticisms of Web3. Let's zoom in on the downside because risk management is the bedrock of long-term survival. Volatility. Crypto assets can move 10-30% in a day. Sizing and diversification matter more than perfect timing. Use stablecoins and tokenized metals to moderate swings if that fits your philosophy. Smart contract and protocol risk. Even audited code can fail. Avoid depositing life savings into a single contract. Prefer battle-tested protocols with bug bounties and transparent governance. Custodial and counterparty risk. Tokenized metals depend on issuers and vaults. Centralized exchanges can freeze withdrawals. Spread risk across venues, know your off-ramps. Rug pulls and social engineering. Anonymous teams can vanish. Fake support DMs will ask for your seed phrase. Don't share it, ever. Build a habit of skepticism. Verify before you trust. Centralization in disguise. Some decentralized projects are controlled by multi-sigs or have lopsided token distributions. Read the docs, check who can upgrade contracts and under what process. Environmental debates. Proof of work consumes energy. Proof of stake reduces that footprint dramatically but changes security assumptions. The discussion is nuanced. Don't rely on slogans. Regulation. Rules are developing rapidly. Expect evolving KYC AML requirements, consumer protection laws, and compliance for asset-backed tokens. Build adaptable processes. EX reality check. Web3 still feels like early computing, powerful but unforgiving. Expect occasional failed transactions, confusing errors, and changing standards. Patience and learning agility pay off. Personal risk policy. Write one page that defines your max allocation to any single protocol, your cold storage rules, how you verify new opportunities, and your emergency response if a wallet is compromised. The future of Web3 in closing. Where does this all go? If Web 1 gave us access to information and Web 2 gave us access to audiences, Web 3 aims to give us access to ownership. In practice, that looks like wallets embedded in apps, assets traveling seamlessly across chains, and tokenized cash flows you can hold like a playlist. Tokenization at scale. Expect treasuries, invoices, carbon credits, property income, and yes, precious metals to trade side by side with stablecoins. This could shrink settlement times from days to minutes and open markets that were once clubby and closed. AI and IoT crossovers. Autonomous agents will need wallets to transact for data, compute, and services. Devices may pay each other micro-fees to share connectivity or energy. Programmable money becomes the fabric for machine commerce. Adoption curve. The winning apps will feel like Web 2 skins with Web 3 guts, familiar, fast, and safe by default. Users won't say, "I used a blockchain." They'll say, "I sent it." Final checklist for newcomers: learn self-custody before you scale. Start with small, repeated reps. Balance crypto with tokenized, safe assets if volatility stresses you. Document your rules and stick to them. Keep learning. This field evolves weekly. Web 3 isn't a guarantee of freedom or prosperity. It's a toolkit. In careful hands, it can reduce friction, widen access, and align incentives. Combined with time-tested assets like gold and silver, it offers new ways to build, protect, and move value. Use it wisely, stay humble, and I'll see you on the next chapter of the internet. This is Felix. See you next time.